Somewhere right now, a billionaire is buying a private island, a fleet of cars, or an entire company, and their tax bill for the year is smaller, as a percentage, than yours. Not because they broke the law. Because they didn't have to. That sentence alone makes most people's blood pressure spike a little. But before you decide who's the villain here, it's worth asking a stranger question. What if the system isn't broken, exactly? What if it's working precisely the way it was built to work, and the real story is about a psychological blind spot most of us share, the assumption that wealth and income are the same thing? They are not. And that single distinction is the hinge this entire story swings on. Picture two people. One earns $90,000 a year at a steady job. Every 2 weeks, a chunk of that paycheck is withheld before it even reaches their bank account. The other person is a billionaire whose net worth grew by $2 billion this year, almost entirely because the value of the company they founded went up on paper. The salaried worker's income is realized the moment they earn it. It's taxed immediately, automatically, with no room to maneuver. The billionaire's gain is unrealized. It exists only as a number representing what their shares would be worth if they sold them. And in the United States, as in most countries, you are not taxed on wealth you haven't converted into cash. This isn't a loophole hidden in fine print. It's one of the oldest, most foundational principles in modern tax law. Income is taxed, not net worth. So how does a billionaire actually live, buy things, fund lifestyles worth hundreds of millions of dollars, without triggering a taxable event? The strategy has a name among tax attorneys and journalists who study it: buy, borrow, die. First, buy assets, like stock in a company, that appreciate in value over time without being sold. Second, instead of selling those assets to get cash, which would trigger capital gains tax, borrow against them. Banks are more than happy to lend enormous sums using billions in stock as collateral, often at very low interest rates, because the loan itself is not considered income. It's debt. And you don't pay income tax on a loan. Third, and this is the part that tends to make people the angriest, die. When assets are passed on to heirs after death, in many jurisdictions those assets receive what's called a stepped-up basis, meaning their value is reset to the current market price for tax purposes. Decades of investment growth can pass to the next generation without ever being taxed as a capital gain at all. A 2021 investigative report by ProPublica, using leaked IRS data, calculated something they called a true tax rate for the wealthiest Americans, comparing taxes paid to the actual growth of their net worth rather than their reported taxable income. Their analysis found that some of the richest individuals in the country paid a true tax rate in the low single digits, in certain years effectively close to zero, while their wealth grew by billions. To be clear, this doesn't mean these individuals were breaking tax law. It means the law, as written, was never designed to tax wealth growth in the first place. It was designed, over a century ago, primarily around the idea of taxing income, back when the ultra-wealthy earned their fortunes mostly through salaries and dividends rather than stock appreciation. Now here's where the psychology comes in, because the reaction most people have to this information isn't really about tax code. It's about fairness, and fairness is one of the oldest, most deeply wired instincts humans have. Researchers studying the psychology of inequity, building on foundational work by economist and behavioral scientist Ernst Fair, have found that humans, and even some primates, show a measurable aversion to unequal outcomes, even when the inequality doesn't personally cost them anything. In experiments where monkeys were given unequal rewards for the same task, the ones receiving the lesser reward would sometimes refuse to participate at all, essentially rejecting a payout rather than accepting an unfair one. That instinct almost certainly evolved for a reason. In small hunter-gatherer groups, unchecked accumulation by one member threatened the survival of everyone else. A group where one person hoarded meat while others starved didn't function as a cooperative unit for long. Fairness monitoring wasn't a nice-to-have trait. It was social glue, and social glue was often the difference between a group that survived a hard winter and one that didn't. Which means when you feel that flash of anger reading about a stepped-up basis or an untaxed loan, you're not being irrational. You're running ancient hardware built to detect exactly this kind of imbalance. Here's the historical twist, though. The current system wasn't built by billionaires plotting in secret. It evolved piece by piece through decades of legislation, much of it originally designed for entirely different, often reasonable purposes. Stepped-up basis rules, for example, were partly intended to simplify estate administration and avoid forcing families to sell businesses or farms just to pay a tax bill after a death in the family. Low capital gains rates relative to income tax were, at various points, championed as incentives for investment, savings, and long-term economic growth. Over decades, wealthy individuals and their advisors didn't need to bend the rules. They simply understood the rules better and faster than the system could adapt to their new financial strategies. Tax law is reactive by nature. It tends to close old loopholes only after the wealth has already moved through them. This is where reasonable people land in genuinely different places. Some economists argue this asymmetry represents a serious structural problem, one where labor is taxed immediately and heavily, while capital is taxed lightly, deferred, or in some cases avoided almost entirely, deepening wealth inequality over generations. Others argue the system, whatever its flaws, still serves legitimate goals, encouraging investment, protecting family businesses, and avoiding the immense practical difficulty of taxing assets that don't have a fixed, agreed-upon value until they're actually sold. Multiple serious proposals, including taxes on unrealized gains for the ultra-wealthy, have been debated in recent years precisely because this tension hasn't been resolved. What almost everyone agrees on, across that disagreement, is the underlying mechanism itself. Wealth and income were never the same thing, and a tax system built primarily around one will always struggle to fully capture the other. The lesson here isn't really about billionaires at all, strange as that sounds. It's about noticing how easily a system built with reasonable intentions, one rule at a time, can produce outcomes that feel deeply unreasonable once enough time and enough leverage accumulate on one side of it. And it's about noticing your own fairness instinct for what it is, not a modern political opinion, but a survival mechanism thousands of years older than the tax code itself, still quietly keeping score. So the next time you see a headline about a billionaire's tax bill, you're not just reading about finance. You're watching one of the oldest instincts in the human brain collide with one of the newest, strangest inventions humans ever built, a system where money can grow without ever technically being earned.